Currency pair. In Forex market, you might saw something like this. This is called currency pair. There's a lot currency pair. Let's take example. This is euro and US dollar. It's basically two combinations of euro and US dollar. The beginning name of currency, it's called base currency. And the currency after the first one is called quote currency. So, euro is the base currency. US dollar is the quote currency. In the Forex market, you might see this. Euro US dollar equal 1.3. But what these means? This actually means that the exchange rate is 1.3. You need 1.3 quote currency to buy one base currency. In other words, you need 1.3 US dollar to buy 1 euro. Now, in currency pairs, there are several types of pair. Major pair, minor pair, and exotic pair. Major pairs are the most traded currency pairs in the world. They always include the US dollar and another major currency. Here are the main major pairs. Minor pairs, or cross-currency pairs, are pairs that don't include the US dollar. They combine two other major currencies. Common example is this. This is euro and Japanese yen. Last, exotic pair. Exotic pairs are made up of one major currency, usually US dollar, and one currency from a developing or smaller economy. Common example is this. This is US dollar against Turkish lira. PIP. PIP stands for percentage in points. PIP reflect the smallest movement in the currency prices. Deals with such large numbers, showing it in a smaller number helps comprehend the movement in price. PIP usually came with 4 decimal number, but at some reason, they came with only 2 decimal number. Let's take example. You see the price of euro US dollar being at 1.3000, and then you see the prices change to 1.3001. We can tell that the prices move up to 0.0001. Or we could say that the prices move up by 1 pip. To add more precision in Forex market, they add extra decimal number in prices. This is called pippets. Pippets is a fraction of pip, basically smaller version of pip. 1 pip equals 10 pippets. In Forex market, when pippets move up reach 10 pippets, it is becoming 1 pip. Lot. Lot is a unit of measurement used in Forex trading to define the size of a trade. In other words, how much of a currency you are buying or selling in a single transaction. When you open a trade in the Forex market, you don't buy $1 or 10 euros. Instead, you trade in lots, which represent standardized quantities of currency. There are 4 main types of lots, each with different sizes. 1. Standard lot. Size, 100,000 units of the base currency. Example, 1 standard lot of euro to US dollar equals 100,000 euros. Movement, 1 pip equals $10. 2. Mini lot. Size, 10,000 units of the base currency. Example, 1 mini lot of euro to US dollar equals 10,000 euros. Movement, 1 pip equals $1. 3. Micro lot. Size, 1,000 units of the base currency. Example, 1 micro lot of euro to US dollar equals 1,000 euros. Movement, 1 pip equals 10 cents. 4. Nano lot. Size, 100 units of the base currency. Example, 1 nano lot of euro to US dollar equals 100 euros. Movement, 1 pip equals 1 cent. Leverage. Leverage in Forex is a loan provided by your broker that allows you to control a much larger trading position than the amount of money you actually have. Leverage is a tool that magnifies your buying power in the market. Example, you have $100 in your trading account. Your broker gives you 1 to 100 leverage. That means, with $100, you can control a position worth $10,000. You don't actually own $10,000. Leverage, for example, 1 to 100. Basically, 1 is an equity or margin, and 100 is position size. The broker is lending you the rest so you can trade larger positions. Remember, leverage doesn't increase your money. It just increases your exposure. Some brokers offer leverage up to 1 to 1,000, but the higher it is, the more dangerous it becomes. Bid and ask price. Imagine you have an apple, and you want to sell it, and businessman came to you and offered the single apple for $2. You agree at $2. Then, businessman looking for someone who wants apple, and sell it with higher price, asking at $2.50. The businessman is a broker. Now in Forex trading, When you selling currency pair, you selling your currency at bid price set by the broker, similar with Apple. And when you buy currency pair, you buying at ask price that's set by broker, similar with Apple. Broker facilitating trader to trading and making profits between them, and this is known as spread. Now move to Forex charts. When you get to Forex charts, you will see these two lines that always moving. The line that on top is ask price line, and the line is on bottom is bid price line. The gap between these two lines is the spread. When you click sell, you selling at bid price. And when you click buy, you buying at ask price. That's all for this video. Hope you understand about the basic. Next video in this channel might be more interesting. Have any suggestions for next video? Write it on comment sections. Subscribe for more useful lessons you could learn, and see you in next video.